As you take a look at investments as a practical matter, how much do you need to take into account at this point the possibility of a real trade war?
So it matters to us, and as asset allocators, we think about emerging market equities versus developed market equities and U.S. equities, for example. But what I would say is that at the moment, we're seeing a small part of the trade aspect from a global perspective. Of course, this could escalate, and you could see retaliation, and that would mean a pretty negative commodities story for emerging markets. But what I would say is, we have to look at the asset class as a whole, and commodities are only one part of the story for emerging market equities these days. We look at emerging markets have become a lot more high-tech, for example. Think Alibaba, Tencent. We like those companies. So when you look at the factors that drive emerging market equities, it's not just about commodities. So I want to minimize it and say that trade issues don't matter, but there's more to the story for emerging market equities in the way we look at it.
But the global synchronized growth story, I understand that's the commodity piece of it, but many are positive about the global economy. If this winds up being implemented in some capacity, does that change the thesis of global synchronized growth? So
the global growth has been amazingly synchronized. I have a Bloomberg dashboard that shows PMIs. There's 17 markets. 15 of them are above 50. And in fact, 7 of them are above 55. Whether trade is going to have a huge impact on that, again, many factors. I would say in general, though, PMIs don't grow to the sky. And at some point, expectations are so high, and we're still staring down the barrel of a 9-year bull market in stocks. There is a tendency for mean reversion, and maybe trade will be the trigger, and we are in an elevated volatility environment these days. So, will we get paid for taking risk this year is a key question.